Well, from homeware catalogues to cutting-edge credit algorithms, few South African companies have rewritten their own story as dramatically as Weaver FinTech. Formerly known as Home Choice, this JSE-listed player has quietly and very profitably pivoted into a fintech player. Today, more than 90% of its profits come from brands like Pages Now and FinChoice, and its customer base has surged past 3.7 million. And this is the first set of interim results under its new name and ticker, WVR, and they tell a story of growth, of margin expansion, and a tech stack that's as much an AI lab as it is a lender at the moment. I'm Michael Avery, and on this episode of the Monocle Banking Podcast, we're going to unpack that transformation with the man steering the ship, CEO Sean Wibberley, from his own career journey to the mechanics of building a high-velocity fintech ecosystem and what the future holds for Weaver in an increasingly competitive financial market. Sean, welcome. Before we get into the numbers, let's just start with your own journey. How did your career path lead you to the helm of what is now Weaver FinTech, and what have been the pivotal moments that shaped your leadership style?
Well, so I come from a family of engineers. So I did engineering at UCT 30 odd years ago. And I knew when I did engineering, I didn't want to necessarily go and work for Union Carbide, who gave me the bursary. I couldn't see myself in the mining sector. And I went overseas and got into technology, into IT, helping grow companies' network operating systems, and then moved into doing the same thing for Halliburton in Angola, so very much in the IT space. And then I realized I needed to get more focused on the business side of IT. So I did an MBA in 1999. And from that, went into consulting, with the primary view being working for Deloitte Digital at the time to start working for industry sectors in the financial services space. I just saw myself working in that space and using technology to design and craft products in what was then just known as financial services. Did that for 2 or 3 years and then moved across to the Capital One Nedbank Alliance. Capital One is a big bank in the US that very much focused on the underserved mass market, using models and analytics to find pockets of excellence within underserved markets in the States. And they brought that tech and that IP to Johannesburg and partnered with Nedbank on a JV. And I got recruited into that. And within a couple of years, I was running the platinum and gold portfolios for American Express. So I was very much on the card side. And I'd always wanted to live in Cape Town. This is where my grandmother's from, where I spent lots of my time. So I knew that if I took a job in Cape Town with Nedbank, or BOE, which was part of Nedbank at the time, what would happen is if my career took off, I'd get promoted back to Johannesburg. So I spent quite a bit of time researching the market and finding a player that had its headquarters here, very much in the retail space or in sort of investment banking, and I didn't fit in either, experience-wise. And then Rick Garrett, who founded Home Choice 40 years ago on April Fool's Day, decided that he needed to really focus on the financial side of the retail business. And this proposition came across my desk, and I then started 19 years ago at what then became known as FinChoice within the Home Choice group. And it sort of took my experience from Capital One, which is very much about mining data and understanding customers and making pre-approved offers to them, and taking that idea or that concept into the retail business, mining the proven Home Choice customers who had already established a trust relationship with Home Choice in terms of buying homewares products at a distance, not face to face.
Yeah.
And started piloting the FinChoice business. So taking the good paying Home Choice customers and offering them credit that they weren't easily able to get at traditional banks or other types of lenders. And back then, very much, if you wanted to do that, you'd have to go and stand in a queue, get in a taxi, potentially be embarrassed to be standing in a queue with lots of other people. And we took that and made it online. Firstly, it was telephonic, as in speaking to people on the phone. And then it became USSD, which was that older technology, very much accessible by then feature phones, and then moved into Mobi. So a mobile app on a feature-rich or smartphone. And now we obviously have an app. We've got customers with legs in the USSD and at Mobi site, and now the app. And the app's the one that's seeing the most growth. We'll probably sunset the USSD in the next year or so. There are some very loyal, stalwart customers still liking it, but it's not really fit for purpose in a dynamic ecosystem like ours now, where you need to see the range and have more disclosures and more understanding. And that's where we are today.
And I think, for decades, Home Choice was the brand that brought the showroom to your living room. And there was that iconic catalog sales pitch. But wait, there's more. And it turns out there was more, much more. The business has really engineered or re-engineered itself into a fintech player, a transformation from a more heritage retail brand to what you're building looks like a fintech ecosystem. So maybe you can just talk to me about this pivot and what the opportunity set is that you saw. Was it market forces and customer behavior? Did that push the business in that direction?
Yeah, I do think that back then, very much the South African lower middle income consumer, and chiefly the female consumer in that segment, was underserved. And that's where Rick Garrett saw that opportunity to serve that consumer and offer the ability to make the homeware products affordable through the extension of credit, which back then was almost unheard of. And taking that learning into actual lending and payments products and so on, was clearly a need that he saw. And his daughter Shirley, who's the chairman of the group, has also been a big proponent of that focus. And the entire business focuses around her as our primary consumer. And I think it's that deep focus on her and her needs and her wants and her day-to-day battles and issues that helps shape a lot of our products. It's not just a loan for 5,000 Rand, it's how that loan is engaged with and understood and sold, and the reassuring nature with which we make it pre-approved, given the data we know on the customer, and so our relationships with our customers last for years. They're not one-off loans. They are very much an engagement in a relationship. And that vision, I guess, is coming into our ecosystem. The ecosystem is a place of trust and reassurance that our customers build a relationship with. And for me, one of the most pleasing things is seeing the proportion of customers to whom we are selling insurance digitally. Because insurance is typically one of those products that is sold by a broker or an outbound telephone center, pushing the product or explaining the product to customers and pushing all the right buttons to make a sale. Whereas all of our products sold in the ecosystem are pull-based. The customer has a need and they come to our ecosystem, navigate it, see a pre-approved product that we offer, and then pull, so to speak, the request for that product. And so from a traditional push-based sale of insurance to a pull-based one, and we now, 46% of our customers are now taking our funeral product, for example, by doing it themselves, I think is testament to how we're making a reassuring, safe, and engaging environment. And I think that's going to go from strength to strength as the ecosystem picks up more momentum and we add additional product lines.
Obviously, this is the first set of results under the Weaver FinTech name. And looking at what you've done, buy now, pay later has been a big part and component of what you're doing. It's often seen as a point of sale credit tool, but you've positioned PayJustNow and PayStretch as core customer acquisition channels. So maybe you could just share how these products fit into the broader Weaver ecosystem by design.
Yeah, so by far and away, the product that is most virally attractive to customers who enter the ecosystem for the first time is the PayJustNow's Buy Now, Pay Later product. So it's one of those innovations that was spawned a few years ago globally and the last few years in SA. And we acquired PayJustNow just over 4 years ago. And it just allows consumers to, at the point of sale, split the purchase. Globally, it's 4 ways. Here we do it 3 ways, 1/3 upfront, 1/3 a month later, 1/3 a month after that, with no interest or fees charged. The merchant picks up a higher commission for the sale, and they benefit because they get more customers through their funnel and they get typically higher basket size because customers are able to potentially buy a pair of sneakers that before they couldn't afford, if you like.
Yeah.
And there's no credit attached to it. So it's basically a free product. It's a no-brainer for anyone in any strata of society to use. I use it all the time at merchants that accept PayJustNow. The mere saving in cost of capital makes sense. And it's 1/3, 1/3, 1/3. We're booking virally 110,000 customers a month into the product. We don't have any meaningful advertising other than some social media around the product. It's mostly word of mouth or customers noticing the PayJustNow method at checkout online or in store. We bring the customers into the ecosystem. Then in order to buy even larger items, in other words, to get credit to, for example, buy a fridge or a TV or what have you, that might be too much to be able to split only over 3 months. We've now offered the PayStretch product, which is a brand we've curated, which is pay in 12 months. And that does attract finance charges. So we're going to launch a Pay in 6, which is in beta mode now.
Yeah.
And no doubt we'll have Pay in 18 and 24 and all sorts of things for different pockets of customers and different needs. But customers come into the ecosystem chiefly because of the buy now, pay later product. Some come in directly because they're looking for credit or for insurance. But 90% of our acquisition comes into the BNPL product. And then our work on is to get the customers onto the ecosystem and engaging on the shopping platform. And I'll talk to that in a second. Customers come on, they get exposure to our financial offerings, which are pre-approved, and we're using as much data as we have on the customer that they've shared with us to be able to make offers that are reasonable to the customer. So it's not, for example, get 30,000 Rand loan and you can only qualify for 7 when you apply. We try and curate our offers so that that's a kind of the social contract we have with customers so that they're reassured. What we offer is more or less what they can get. And then that builds trust in the platform. They get to see other offers. And then, for example, are taking our funeral product, which on a pull basis, I think is an extraordinary sort of outcome. And it's testament to the trust.
Yeah. It isn't about splitting payments into 3 or 12. This is about building deep customer relationships, feeding that behavioral data into your lending algorithms, and then creating a product ladder that keeps customers inside your ecosystem. I think it's very smart by design. 110,000 buy now, pay later signups each month. What proportion of these are first-time credit customers, and how many of those are migrating into other Weaver products like personal loans or insurance?
Yeah, so in terms of the first question, so what portion of the intake are first-to-credit customers? So the buy now, pay later product, both here and globally, does tend to attract a younger consumer because there's no fees and charges. And also because the term of this product is, in our world, it's on average 43 days. So it's a very tolerant product from a risk perspective. So we're able to approve what are known as thin file bureau records, as you would well know. So customers who don't have much credit experience, they don't have any data going through the bureau to augment their score or lift it up. And it's a great product to get younger or first-time credit customers onto a product, exhibit good payment behavior going forward, and then because of that, be able to qualify for traditional credit elsewhere. And with a better bureau score, having access potentially to better credit interest rates and so on. That does, of course, require that we would be reporting this to the credit bureau and so on. And that's an active conversation we have with SACRA and the credit bureau, is reporting of what we do and what other providers of buy now, pay later are also doing. That's a work in progress, and I think it'll be a great thing once that's done, because it will mean that people who are using our product are building up their credit profile. But that said, they are building up their credit profile within our ecosystem. So first-time credit user uses buy now, pay later. They show some good payment behavior with us within the group. And this is data that only we have access to because it's not shared with any bureau at the moment. And we're able to then go, look, that's decent behavior. And our models are showing that you're a better risk customer. And would you like an entry-level loan so that you can get into the credit market? So that is one of the key wins of an ecosystem, is having data elements from your different component product sets that are generating behavioral data on repayments, on affordability, on how good you are with honoring your payment on time, et cetera, and then being able to cross-sell customers with meaningful offers that they will likely be approved for, because our models are getting better and better at predicting these outcomes.
And with PayStretch, as you say, targeting bigger ticket items with longer terms than traditional buy now, pay later, you can then use that to manage credit risk and default exposure on those longer repayment horizons. What are you seeing when it comes to the default rates? Because you did highlight in these interims that your buy now, pay later credit risk is stable at under 2% GMV.
Yeah.
And I mean, that's phenomenal.
Yeah, no, it is extraordinary, but I hesitate to say, this is a short-term product. It's risk tolerant, and the team have done a fantastic job on their fraud models and their behavioral risk models to keep the risk, under 2%. And it's how we've built up our data on customers and how we've understood them. And, first-time customers tend to have higher risk than second and third-time customers because you learn more. And over the years, we've worked out which pockets of acquisition are good for us. And obviously, more and more of our customer base on BNPL is not the new 110,000 a month. It's the 3 million that are already existing who are doing repeat purchases. And so we find that customers from, let's say, 4 years ago that started on buy now, pay later, they get more and more used to the platform. It's a really good way to shop. It's a no-brainer. It makes checkout faster. It splits the payment, etc. So we're seeing higher frequency and basket usage over the course of a year, and the higher the year thereafter. So customers are using this product, and because they're using it and staying on our books, it means they're paying and bringing down the capital at risk for the portfolio to well under 2%. And then we can take that immediate data and augment it with our lending books. So if there's distress in any one of our portfolios, we can tighten the credit across the ecosystem patch, so to speak. And another power of the ecosystem is you've just got more data points that you can reference in real time before making further credit decisions with customers.
And speaking of that data, it shows that customers with more than 3 products generate 12 times average revenue per user, ARPU. What role does the buy now, pay later play in accelerating that product stacking behavior?
Well, so the buy now, pay later product, which earns a margin from the merchants only in terms of how it earns its revenues, that's a relatively lower margin product. It's profitable, but on a unit basis, but it's not as high a margin as you would charge for lending and insurance. Lending, you've got the money out there for longer. You're having to borrow a lot of funds that are out in the market for longer. So the book turns more slowly and for longer terms. In the lending portfolio, we have to be a bit tighter with the buy now, pay later, less so. We get customers in and then we can march them up into the other products. But in terms of how it's contributing to the ARPU, so customers with one product, back when we were just FinChoice, that first product would traditionally be a loan and with a higher average ARPU. As we book more and more first-time product customers on the BNPL product, that ARPU naturally comes down because you've got a lower margin product, but there's a lot more of them. And then getting customers to take that second or third product, which typically in the insurance or the lending space brings up the margin nicely. As you called out, the ARPU for a first-time product customer on average is just under 1,000 Rand for a 12-month period in terms of revenue earned. And the second and third products jumps to, almost 12 times that on the third product. And it really is about the customer then adopting to our higher margin products. And not all of them qualify for the higher margin products, obviously. Being credit products, there's a lot more rigor and credit risk requirements around that because the products are larger and over a longer period of time.
The fee-based income now represents, I think, 28% of revenue. That's up from 25%. How far can you push that mix shift before it impacts lending volumes? What's the end state target here?
That metric you just quoted, that's an overall group metric, including the home choice retail business. If we look only at the FinTech business, the mix of fee income is now about 36.5%. It's been growing steadily, and our target is to get to 50% or more. And the reason we think we can do this is growing out the insurance portfolio, that straight fee income. On the B2B side, we charge fees to merchants for the checkout as a service, namely the BNPL or the PayStretch product. Marketing as a service is a strong growth area for us this year. So we have more than 3 million shoppers on the Pages Now platform and over 3,000 merchants. And because of the transactions and the engagements of customers and the repayments that they're doing, we're building up a strong data set and then understanding customers better. And we've revamped the Pages Now shopping destination so that using that data the UX has been revamped, but we're now being able to show more relevant merchant and brand and product offerings within that real estate that customers can see, namely an impression, click on because it's relevant, and then go to that merchant site and conclude a sale, ideally with one of our payment products. And that marketing as a service is a revenue stream for us now with our merchants, so driving relevant traffic at high conversion rates. The third element in the B2B space is analytics as a service, so taking, again, all that wealth of data, mining it and providing insights back to merchants on customer behavior, customer pockets, opportunities for customers in other segments that maybe that retailer hasn't had exposure to. And we can show them industry and sector-wide data in comparison to theirs. That's another value add for merchants for which we would earn fee-based income. Last year, I guess it's getting more broadly into value-added services, vouchers, money transfers, things like that, which are quite common in the market. But when you have a big ecosystem, they're a nice layer to put on top. And you're adding value to customers, and these are all going to be commission and fee-based income. So the target, as I said, getting to about 50% fee-based income, which is good from a cash flow point of view and balancing the portfolio between fees and credit income.
Really is remarkable. I know that the National Credit Regulator and the Competition Commission are watching buy now, pay later closely. What would potential regulation mean for your business, for your approval process or your fee structures or your merchant relationships? And how do you monitor for what they call, I think it's silent over-indebtedness, where customers juggle multiple of these BNPL accounts across providers?
So, firstly, we look at our own data. So, as I said before, buy now, pay later is not at the moment legislated, even by regulatory bodies, never mind actual law, to report buy now, pay later to the credit bureaus. And we've been ready since March to do that, and there's been delays in the system to have that scaled across the patch. So I would definitely recommend that gets done to put more visibility onto it. But, in terms of customers stacking multiple BNPL providers and so on, that is a problem that one tends to hear about from overseas. Locally, we've got Pages now, and there are 2 or 3 other competitors in the space. It's not necessarily a flooded market. And what we see is our capital risk is well under 2%. And so we obviously monitor for distress here and deal with that, when the outcome being our very low bad rates. So now I'm comfortable with where we are. And as I said, I'm very keen to see reporting at the Bureau happen. The other form of regulation that's been spoken about in the other sort of first world markets, Australia, the UK, US, and Europe, is about are affordability assessments taken into account. And this is a very low value, short-term type of product with no interest and fees. It's a very inclusive product, especially for thin file customers. So we would advocate about not having lots of red tape in terms of doing this. Our behavioral models, our fraud scorecards, our income estimators, and so on, have proven to be working very, very well. The last thing you want is sort of red tape, for example, paperwork entering affordability, which I think would be really bad for the economy in general.
No, absolutely. In a country where we talk about financial inclusion, 70% of your customers are female, average age 37, average income 17,300 Rand. This is the way we can create greater financial inclusion using data and fintechs and these new models in a very responsible way. Just as a last question, Sean, interestingly, I see that over 50% of your engineers now use Copilot, 25% of your code generated by AI. Just remarkable. It's really beyond buzzword. How is this impacting your product rollout speed and the quality of your business in the real world?
The average engineer has just become more efficient and more accurate. So a lot of the code that Copilot would share with the coder as they're coding dynamically has perfect syntax. The machine doesn't make errors in its coding, so to speak, in the syntax. So it reduces a lot of that kind of friction in a developer. It also is able to run testing of the code in a way that the developer is serving up blocks of code that has been knocked around by the AI well before it gets pulled into the system. That just makes the developers a lot faster. And, there's change management going on. Some developers are quite precious about coding the old way and doing things the way they've been schooled. But I think more and more, you only have to use ChatGPT to realize how profound it is in terms of being able to create paragraphs and words and check things and summarize and so on. That's happening in the coding space.
Yeah.
And becomes more and more of a no-brainer that developers understand it, they embrace it, and they become more effective because of it. And as I said, the quality and the ability to QA it in real time is a real plus as well.
Well, from a retailer's back-office credit book to a data-driven, AI-enhanced fintech platform, Weaver's journey under Sean Wibberley is certainly nothing if not a reminder that reinvention is as much a survival strategy as it is something that is very often led by opportunity. And as the results show, the group is finding new ways to monetize inclusion, to scale its ecosystem, and to hold its own in a space where both banks and disruptors are circling at the moment. Whether Weaver can keep that momentum will depend on its ability to keep innovating without losing sight of the customer at the heart of all of that story. For the Monocle Banking Podcast, I'm Michael Avery. Until next time, take care.